The recent stock market turbulence has sparked fears of a potential recession. With the Dow dropping and worldwide indices experiencing significant declines, investors are growing increasingly worried. Are we on the brink of an economic downturn? Let's find out. The global market experienced important turbulence, with the Dow dropping more than 1,000 points and the Nasdaq experiencing a 3.5% decline. These trends were mirrored worldwide, with Japan's Nikkei 225 index showing an unprecedented 12% decline, marking its worst ever day. This market sell-off came about due to three prominent concerns. Firstly, the growing worry surrounding a potential recession was driving investor fear. Secondly, people are concerned that the Federal Reserve isn't moving fast enough to quell these fears. Lastly, some investors are uncertain about the efficacy of the AI technology in which they have invested. These doubts were fueled in part by the increase in the U.S. unemployment rate, which jumped unexpectedly in July, though the U.S. economy remains relatively strong, with healthy consumer spending. The sudden uptick in unemployment has led to significant alarm. While Goldman Sachs economists are still holding caution, the odds of a recession in the next 12 months have increased to 1 in 4. Though the case is limited, with overall economic data robust, the larger potential repercussions of these economic fears are still unknown, leaving many investors nervous. Despite this market turmoil, workers and investors are holding their breath to see how the U.S., itself an economic stronghold, will weather this financial storm. Is the Fed making a mistake by not cutting rates? Experts say an emergency cut might be needed. The stock market has been on a record-breaking streak this year, thanks to falling inflation and the expectation that the Federal Reserve, Fed, would shift from raising interest rates to cutting them. However, last week, the Fed did not cut rates as many had hoped, and this decision is causing concern among investors. Experts believe that the Fed has a poor track record when it comes to timing rate cuts and hikes. In fact, it had to play catch-up in 2022 by implementing multiple rate hikes to control inflation. Some economists argue that the Fed should have started cutting rates earlier. The potential benefits of rate cuts include lower borrowing costs for businesses, which can lead to increased hiring. However, it takes time for these policy decisions to have an impact on the economy. With inflation cooling down and the unemployment rate rising, there is a fear that the Fed may be too late in taking action, and this delay could result in widespread layoffs. The Fed's upcoming meetings are scheduled for September, November, and December. Analysts at Citigroup and J.P. Morgan predict that the Fed will slash rates by half a point at the next two meetings. However, there are concerns that this might be too late, and the Fed may need to make an emergency rate cut before then. Jeremy Siegel, a renowned finance professor, believes that an emergency rate cut is exactly what the Fed needs to do. He argues that the Fed is currently far behind in its actions and that the data does not provide any comfort. An emergency rate cut has not been seen since the early days of the COVID pandemic. Tech stocks face uncertainty as AI profits remain elusive. In the past couple of years, tech stocks experienced a huge surge in value due to the high expectations surrounding companies involved in artificial intelligence, AI. Many believed that AI would bring about a new global industrial revolution. However, AI profits have been extremely limited, and the technology itself is still in its early stages of development. This has raised doubts about whether AI will ever reach its full potential. As a result, traders are starting to sell off their investments in tech giants like Apple, Nvidia, Microsoft, Meta, Amazon, Alphabet, and others. These stocks had been on a remarkable upward trend since the beginning of last year, but now investors are becoming more cautious. Even Warren Buffett, the CEO of Berkshire Hathaway and known for his calm approach during market volatility, has decided to reduce his stake in Apple, which is seen as a concerning sign for the overall health of the tech sector. This is worrisome because these companies are each valued at close to or over $1 trillion, and they make up a significant portion of the overall value of the S&P 500. When investors start selling off their tech stocks, it has a massive negative impact on the broader market. This is why the recent trend of selling tech stocks is causing concern among investors and analysts, as it has the potential to significantly harm the overall market. Investors seek safety as tech stocks decline. Investors are feeling uneasy and are selling off assets such as oil, cryptocurrencies, and particularly tech stocks. Instead, they are turning to safer options like bonds, which has resulted in lower treasury yields. While this shift in investment strategy may pose challenges for some retirement accounts, individuals who are nearing retirement could actually benefit if they have a significant portion of their portfolio invested in bonds. Bonds are currently benefiting from the flight to safety. If the Federal Reserve decides to lower interest rates, it could potentially decrease mortgage rates, car loan rates, and other consumer loan costs. However, it may also mean that individuals with money in savings accounts earn less interest in the coming months. It's important not to panic in this situation. The current market conditions do not indicate a market crash, at least not at this moment. Investors are feeling nervous, but they are not in a state of panic. In fact, if Monday's market decline remains at its current levels, it wouldn't even rank among the top 100 worst days in market history. The main question now is how long this fear will last before investors start to see it as an opportunity to buy stocks at lower prices. Recent confusion in the stock market. The stock market can be volatile, and recent events demonstrate just how quickly things can change. Just a month ago, the United States stock indices were breaking records, fueled by the rise of artificial intelligence investments. However, investors became concerned when the U.S. economy showed signs of slowing, and this was highlighted in a disappointing job report. The country added significantly fewer jobs than expected, and unemployment rose. Meanwhile, Japan's central bank raised interest rates, which caused a further rise in the yen, leading to higher loan costs and foreign exchange losses for investors. Last Friday, there was a massive sell-off, and stock indices worldwide experienced a major downturn. This is what some are calling a Black Monday. In the US alone, the Nasdaq index lost almost 9% over the past 2 days, while European markets were also down sharply. Some economists believe that recent market volatility can be traced back to issues with stock valuations. Moreover, a well-known economic indicator, the SOM rule, which measures unemployment rates, has made some wary of an impending recession. Despite this, the U.S. economy is still healthy by most measures. However, there is some concern that the Fed should have cut interest rates earlier to prevent a recession. JP Morgan has put the probability of a recession at 50%, while Goldman Sachs analysts have suggested the likelihood is at 25%, up from 15%. Many analysts believe that the U.S. central bank may have to cut rates more aggressively in the fall, or even act sooner with an emergency rate cut. Concerns about how long the AI investment boom can continue have also arisen, with reports of disappointing earnings from some U.S. tech giants. Some experts believe that this recent sell-off is a sign that the AI bubble has started to implode. All in all, stock market concerns have caused many investors to become cautious as to how much investment they make in various platforms. So that's all for today's video. If you like it, click the like and bell buttons. We'll have another video for you soon. Take care until then.